Hello and welcome to Mild CPA Review. I'm your National Instructor Varun Jain, and today we'll start with the Financial Accounting and Reporting section of the CPA exam. So all you future certified public accountants out here, financial accounting and reporting has got basically two parts. First, you're taking care of financial accounting, you're doing journals, ledgers, trial balance, and then financial reporting, when you report the balance sheet, the income statement. We'll talk about the statement of comprehensive income, stockholders' equity, cash flows, a lot of notes to these financials. So guys, as you can already guess, there's a lot of content in this section, but this is really important, not only for your CPA exams, but even for your real life careers as CPAs. So let's say when you're working as an accountant in the industry after becoming a CPA, you're going to account for your company's millions and billions of dollars of transactions, their assets, liabilities, equity. You're going to account for all that and then report that in financial statements. Let's say you decide to work as an auditor. In that case, you step in, somebody else is preparing the financials, you pick up the management's financials, you examine these financials and you express an opinion on these numbers, whether these numbers are true and fair, whether they are presented fairly in all material respects. Let's say you decide to become a financial analyst on Wall Street. Now you're going to pick up these numbers, you're going to make decisions based on these numbers. So let's say you become an equity research analyst. So you would advise your investors to buy, sell, hold stock based on what decisions you've made on these numbers. You could become an investment banker, buy-side analyst, sell-side analyst. You could raise capital for your client, equity and debt. Guys, what I'm trying to say here is most of the jobs that you're going to be doing as CPAs, you're going to need to understand these financial statements. And with the start of FAR, of Financial Accounting and Reporting, the first thing that I'll tell you about these financials is these are as per US GAAP, US Generally Accepted Accounting Principles. Now, the legal authority to establish US GAAP rules, that's with the SEC, the Securities and Exchange Commission. But the SEC has to a great extent allowed the accounting profession to take care of this. So you have the AICPA, the American Institute of Certified Public Accountants. So they had a couple of part-time committees which did GAAP. So you had the Committee on Accounting Procedures that was created way back in the 30s, and since 1939 they have been issuing accounting research bulletins. Now in 1959 they replaced this committee with a new one. So you had a new AICPA part-time committee known as the Accounting Principles Board, which issued opinions. So that was in 1959 through 1973. In 73 they said, we want a full-time body to do US GAAP, to create the standards, the rules. That's when you had FASB coming in. So you had FASB coming up and issuing statements of financial accounting standards. FASB stands for Financial Accounting Standards Board, and that's the authority for US GAAP. So you had FASB coming out in 1973 and issuing all these very important standards. Apart from that, FASB also issued interpretations. They had their technical bulletins, they had FASB staff positions. So all this coming out of FASB. So guys, there's a lot of content, a lot of pronouncements which create US GAAP. Apart from this, you also have EITF abstracts. Now, EITF stands for Emerging Issues Task Force. Basically, the EITF takes care of new and unusual transactions that emerge in the short run. So you have new transactions, unusual transactions coming in, EITF takes care, because it's going to take some time to create standards out of those new unusual transactions. Plus, you had now these two boards, these two committees, they were AICPA committees. So I had opinions. Again, you could say it's the AICPA's opinions, AICPA's bulletin. Apart from that, AICPA also issues practice bulletins, statements of positions. So even that is authoritative literature for US GAAP. How about SEC? So though the SEC has given most of the authority right now to FASB and had given to the accounting profession, SEC also has a lot of relevant literature for US GAAP. So SEC has got regulation SX, we'll talk about that. they release financial reporting releases, FRRs, they have accounting series releases, ASR, interpretive releases, IR, staff guidance. There's a lot of stuff coming out. So guys, as you realize, there's a lot of pronouncements which create US GAAP. Now this could be very messy, could look very disorganized. You have an accounting issue, you don't know, you're looking at here, you're looking at opinions, you're looking at bulletins, you're looking at SEC literature, AICPA, a lot of stuff, well of places where you could be looking out for it. So in 2009, what they did was they brought everything together. So they reorganized, rebundled everything and created the accounting standards codification. They basically codified the entire authoritative US GAAP literature. So now ASC is equal to US GAAP. Now ASC did not create any new rules. They picked up all the existing rules, reorganized, rebundled it so that it looks more organized. It's got new codes. That's why the accounting standards codification. That was done back in 2009, and it made it really systematic and organized. So ASC is all authoritative literature for GAAP. So it's got all the FASB standards, the EBP's opinions, the CAP's bulletins, EITF's abstracts, AICPA releases. It's also got SEC literature, but that's only relevant SEC literature for accounting and reporting. Now, what's not included in the ASC? So you have all the standards, all the rules included in the US GAAP authoritative literature, the accounting standards codification. What's not included is the concepts. So you have SFAC or Statements of Financial Accounting Concepts. That's not included in the ASC. Because guys, we'll talk about these concepts in the next section. These concepts are not for the entities to use. For the entities, you got the standards, you got the rules. These concepts are for the rule makers. This is, let's say, for the FASB to create the standards, the rules. So concepts is not authoritative literatures. You have standards, opinions, bulletins, all the stuff, all these pronouncements, that's authoritative literature. So all that's included in the ASC. So this is used by all non-governmental entities, all commercial, not-for-profit entities use the US GAAP to create their financials. But they don't use concepts. Why? Because concepts are for the rule makers to create these rules. Let's get to the book, do a bit of highlighting on this stuff. Looks heavy, but trust me, it's really interesting. And we'll come back, and in the first section, we're going to talk about these concepts or the rules for the rule makers to create the rules. On page 3 of FAR 1, we are looking at the standard setting bodies and hierarchy of US GAAP. So highlight SEC, Securities and Exchange Commission, and we know that SEC has legal authority to establish US GAAP. On the second sub-bullet there, highlight SEC rules and regulations apply to all companies that issue securities in the US, and these are issuers. So we've seen that we had the Committee on Accounting Procedures, CAP, from 1939 to 59. We had the Accounting Principles Board, APB, from 59 through 1973. And now we have highlight FASB, Financial Accounting Standards Board. Highlight through 2009, FASB issued Statements of Financial Accounting Standards, SFAS. And then the last two lines on this page highlight in 2009, FASB reorganized all GAAP pronouncements to create the Accounting Standards Codification, ASC. And we'll talk a lot on ASC, especially on the research simulation that we'll have on the CPA exam. Now, turn on to page 4. And on page 4, we are looking at highlight Accounting Standards Codification, ASC. Highlight single source of authoritative non-governmental US GAAP. And on the next bullet, underline reorganized. So the ASC basically reorganized. It didn't change, but it reorganized all the GAAP pronouncements into approximately 90 topics. So that's created only two levels of GAAP hierarchy, authoritative and non-authoritative GAAP. First, let's look at authoritative GAAP. So on the first box there, you have FASB, circle FASB and underline Statements of Financial Accounting Standards, SFAS. Then you have APB, underline APB Opinions. You got CAP, underline Accounting Research Bulletins. And on the right, I have a tick there, and below the tick, highlight all authoritative GAAP pronouncements are reorganized into the ASC. Then below the chart, we have non-authoritative GAAP which are not included in the ASC, like highlight Statement of Financial Accounting Concepts, SFAC, and underline these are rules for the rule makers. So on the right, I got a cross, and below the cross, highlight non-authoritative GAAP excluded from ASC. And then towards the bottom of the page, we got SEC pronouncements, where only relevant portions of SEC pronouncements are included in the ASC. So below the tick on the right, highlight include only relevant portions of SEC pronouncements in the ASC. Now move on to page 5, and here we have ASC categories. Now as I told you, you don't need to remember the topic numbers, but it's still good to have a look at this overview that I've presented here. So if you look at it, general principles are topic numbers 100 to 199. Presentation of financial statements, that's 200 to 299. Then you got assets, liabilities and equity. Put a bracket around assets, liabilities, equity and write B/S. So you can understand these are basically the balance sheet items that we're going to be looking at. Then you got revenue and expenses. Put a bracket and write I/S, income statement. So guys, in the first section in financial accounting and reporting, we're going to focus our attention on SFAC, or the Statements of Financial Accounting Concepts. Then we'll move on and look at the income statement and the balance sheet. So guys, as you can understand, there's a lot to come and we're set for a lot of fun. So we've now seen that the FASB, or the Financial Accounting Standards Board, they establish US GAAP, that's generally accepted accounting principles in the United States. Now internationally, we have another board called the IASB, or the International Accounting Standards Board, which establishes IFRS, or the International Financial Reporting Standards. So US GAAP, that's a set of accounting standards for the United States. IFRS, that's standards internationally. So guys, though US GAAP and IFRS, a lot of rules, a lot of principles are common, there are certain crucial differences between GAAP and IFRS. I'll give you a quick example. US GAAP, that's pretty much rules based. It's going to tell you exactly how you're supposed to be accounting and reporting for stuff. IFRS is a little more principles based. So there might be circumstances where IFRS is going to let you decide how you're supposed to be accounting or reporting stuff. So we're going to talk about differences between GAAP and IFRS in a lot more detail as we move along with the course. But for now, let's try to look at it from the perspective of an MNC, a company operating across geographies. So if a US parent has got subsidiaries in Europe, for the US parent, they're using GAAP. For the European subsidiaries, they're using IFRS. And when the European subsidiaries get consolidated with the US parent, they again have to get consolidated with GAAP numbers because the parent is US. So it creates a lot of complications. It's pretty much expensive. You know, it's even difficult to raise capital across geographies because investors need to know both GAAP and IFRS. It's also difficult to compare companies across boundaries. So let's say we want to compare Walmart in the US to Tesco in the UK. Walmart, they're doing GAAP financials. Tesco, they're doing IFRS. That makes it so very difficult, so very complex. Now, this is something which FASB and the IASB understood way back in 2002. So both these boards, they met and they decided they're going to converge US GAAP and IFRS. They plan to create a single set of high quality global accounting standards so that companies can use these standards for both domestic and cross-border financial reporting. Now, although the boards have made significant progress towards convergence. There are still a lot of convergence projects still in progress. Now, we really don't know how long they would take to converge GAAP and IFRS, but the good thing is, since 2011, the AICPA has included IFRS on the CPA exam syllabus. So guys, after being CPAs, you're not only going to be American or US accountants, you guys are all set to be global accountants. Now, towards the second half of page 5, we're talking about IFRS. So highlight International Accounting Standards Board or IASB and highlight International Financial Reporting Standards, that's IFRS. Then in the next bullet, we're talking about convergence of US GAAP and IFRS. Make a little note here, right? FASB is equal to US GAAP, right? IASB is equal to IFRS. So we know the FASB, the Financial Accounting Standards Board, they issue US GAAP. IASB, the International Accounting Standards Board, they issue IFRS. Now, we've talked about that the FASB and the IASB, they've been working together towards the international convergence of accounting standards since 2002. Now, the goal here is to create a single set of high-quality global accounting standards that companies can use for both domestic and cross-border financial reporting. Now, the Convergence project is also supported by the SEC, which is considering the incorporation of IFRS into the US financial reporting system. In the first part of FAR 1, we're going to look at these concepts as per the Statement of Financial Accounting Concepts. Guys, as I told you, these are rules for the rule makers to make the rules, not included in the AFC because this is not authoritative literature. So the way we're going to study concepts is, so we're going to look at the concepts. We're going to talk about elements of financial statements. Then next we're going to talk about primary objectives of financial reporting. So we're going to look at objectives. Then we're going to move on and talk about qualitative characteristics of financial statements. So qualities or qualitative characteristics. Then we're going to talk about recognition and measurement rules. Recognition and measurement. We are then going to look at cash flows and present values. So cash flows and present values. And finally, we'll look at the accounting cycle. So all the accounting then leading to reporting. So as I told you, financial accounting and reporting. So that's the accounting cycle. So let's first start with elements of financial statements. So let's do the elements on the board right here. So guys, all of us have done balance sheets. So balance sheet is a statement of financial position as of the end of the period. So the management, they're going to have assets, we're going to have liabilities, and you're going to have equity. So let's put in some numbers. Let's say this company, they've got 100 assets, $100 worth of assets. It could be $100,000 worth of assets, 70,000 worth of liabilities, and the remaining 100 minus 70, that's 30 of equity. Now, how do you get this number 30 for equity? I mean, we did 100 minus 70, but the way you get it is via a statement of stockholders' equity. So let's do that here. So statements of stockholders' equity. So you have investment from owners. So this could be, let's say, common stock plus APIC. So common stock plus additional paid-in capital. This is money which is invested by the owners. Let's say this company started off this year and the owners invested $25,000. And the company during the year, they had comprehensive income of $10,000. So comprehensive income of, let's say, 10. So, and they distributed out dividends, distributions to owners. So they took in 25,000 from the owners. Now they're distributing back money to the owners of $5,000. So distribution to owners, let's say, is 5. This gets you 25, 35, 30. This is the 30 that you have right here. Then let's draw an income statement. So you have the income statement. On the income statement, we're going to have revenues plus gains. Let's say they've done revenues plus gains of $60,000 during the year. Let me do it in blue. And they have expenses and losses. Let's put that number to 50. That gives us 10. Oh, this is the 10 that we have right here. So guys, I'm sure you're able to understand the flow. So we're saying revenues plus gains minus expenses minus losses gives us comprehensive income. Investment from owners plus comprehensive income minus distribution to owners gives us equity. Assets is equal to liabilities plus equity, or asset minus liabilities is equal to equity. So these are the elements of financial statements. So we have assets, that's one element. Liabilities, that's the second. Equity, you have investment from owners. Comprehensive income. Okay, we know net income, we know income. We'll talk about comprehensive income when we're talking about the income statement. Now, distribution to owners, you have revenues, you have gains, expenses, losses. So let's count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. As per US GAAP, the financial statements, they've got all these 10 elements. So a full set of financial statements we learn includes the balance sheet, the income statement, the statement of comprehensive income. As I told you, we'll talk about comprehensive income as we move on. The fourth is the statement of stockholders' equity. Fifth, you have the statement of cash flows, and then you have notes to the financials. So let's get to the book, look at the elements, and we'll come back and talk about objectives of general purpose financial reporting. On page 6, we're looking at elements of financial statements. Now, a full set of financial statements comprise the statement of financial position, that's your balance sheet, the statement of earnings, that's the income statement, the statement of comprehensive income, statement of cash flows, and the statement of stockholders' equity. Now, we're looking at the elements of these financial statements. So right there, FASB Conceptual Framework is equal to 10 elements. So the FASB Conceptual Framework, that comprises 10 elements. So first 3 elements, we're looking at assets minus liabilities is equal to equity. And this is something we present on the balance sheet. So on the left there, write B/S. Now the equity section of the balance sheet, that comprises investment by owners, distribution to owners, and comprehensive income. So on the left there, write S/E because all this is presented on the statement of stockholders' equity. Then when you're looking at comprehensive income, that comprises your revenues and gains less expenses and losses. So on the left there, write I/S. So you got comprehensive income on the statement of comprehensive income, which is basically an extension of your income statement. So the net income number that you get from your income statement, you add other comprehensive income, and that makes it comprehensive income. On the next page, page 7, we're looking at IFRS. Now IFRS, instead of having 10 elements, they've got 5 elements. So write IASB Conceptual Framework is equal to 5 elements. So the first 3 elements that you're looking at, assets minus liabilities is equal to equity. On the left there, write B/S because that's there on your balance sheet. Now equity, you got income and expenses, and on the left you can write I/S because that's there on your income statement. So guys, as you can understand, we're looking at the financial statements and we are trying to understand the elements that create those financials. Now that we've looked at the 10 elements of these financial statements, let's look at the objectives. Why do we need to prepare these financial statements? So we have the primary objectives of financial reporting. Now, the purpose of preparing these financials is for the users because we want to provide information to the users of these financial statements. Now, who are the users? It could be existing as well as potential investors in the company. It could be the lenders and the creditors of the company. So we want to give them some direct information, certain indirect information. So the direct information, so users, they get certain direct information. So when they look at the balance sheet, so when they look at this balance sheet, they get information about the financial position of the company. When they look at the income statement, they get information about the financial performance, the operational performance of the company. So financial performance. When they look at the statement of cash flows, they have an idea about the financial performance relating to cash flows of the company. So all this is direct information which goes into the users. Now, looking at these financials, users also get certain indirect information. Now, this indirect information that users get looking at these financials is very important, is about management's performance. How has the management performed during the year? So guys, they get certain direct information about what's the financial position, how has the company performed. Indirect information, how has the management, have they done a good job? Do they deserve a higher bonus or they need to be fired? On page 8, we're looking at the primary objectives of financial reporting. So right, focus is on the informational needs of external users. So via all your financial reporting, you are focusing on the informational needs of external users. On the first line there, highlight users, highlight existing and potential investors, lenders and creditors. So on the second bullet there, you got direct and indirect information. So the financial statements highlight direct information. So direct information is about the entity's underlying financial position, and above that write balance sheet, B/S. Entity's financial performance, so underline financial performance, and over that write I/S or your income statement, and the entity's cash flows. So again, underline cash flows and write C/F. So that's the direct information about the entity's financial position, the entity's financial performance and the entity's cash flows. Now, next line, highlight indirect information, and this indirect information is about management's performance. So put a box around management performance. So we're looking at financial accounting concepts. We've already looked at elements of financial statements and objectives of financial statements. So we've looked at elements of financial statements out here, and we've looked at the reason why we prepare financial statements. Let's now look at qualitative characteristics of financial statements or qualities of financial reporting. Now guys, before I move on with this, we have done a little bit. We've started on with FAR 1. We have a long way to go for the financial accounting and reporting section. Lots of hard work, lots of focus, lots of concentration from you guys. Because all of you are here to review and pass CPA at miles. So guys, remember this always. You're here to review and pass CPA at miles. Now I understand CPA, that's a big word, certified public accountant. There's a mental block, or there's something which is holding you back from becoming a CPA. You could say there's a fence between you and CPA. So there is a fence. So there's a fence between you and destination CPA. Now I'm going to make sure I don't let this fence remain. So this fence would be cut by me. So I would cut this fence. So the fence is cut by Varun. So guys, you are here to review and pass CPA at miles. There's something which is holding you back from CPA. There's a fence in between, and that fence is going to be cut by Varun. Now wait a minute. I was supposed to be talking about the qualities of financial statements. Have I started talking about my own qualities? No. I'm still talking about the qualities of financial statements. So let's look at this. So these financial statements, they have certain primary qualities. So the first primary quality of these financial statements is relevance. Now, for relevance, there are two ingredients, P and C. P stands for predictive value and C stands for confirmatory value. So guys, by relevance, we mean that these financial statements, they must be useful. By predictive value, we say these financial statements, for them to be useful, they must be able to predict the future. If we are looking at the financials of this year, we must be able to predict the financials of next year. Also, they must have confirmatory value. They must be able to confirm prior predictions, because last year we made a prediction about this year. So when we look at this year's actual financials, are we able to confirm last year's predictions? So for the financial statements to be relevant, for them to be useful, they must have predictive value and confirmatory value. And for all this, we would need to determine materiality. Now, materiality is an entity-specific concept. Now, if you're looking at Walmart financials, billions and billions of dollars, maybe a few $1,000,000 may not be as material as it would be to a smaller entity which is, let's say, doing a $20 million turnover. So materiality would be entity specific. So that helps in determining what is relevant, what is useful. For relevance, two ingredients, predictive value, confirmatory value. So that's why I told you guys, review and pass CPA at miles. But you guys told me that there's something keeping you away from CPA. There's a fence in between. So fence, that's your second primary quality. So number 2, F stands for faithful representation. In other words, these financials, they must not only be relevant or useful, they must also be represented faithfully. That means they must be reliable, they must be error free, they must be neutral, so they must be free of any errors, they must be unbiased. Also, they're required to be complete. So relevance, the first primary quality, had two ingredients, predictive value, confirmatory value. Faithful representation, the second primary quality, has got three ingredients, error-free, neutrality and completeness. So as I told you, this fence which is keeping you guys away from CPA, I'm going to cut it. So the E stands for enhancing qualitative characteristics. So enhancing qualities. So here we had primary qualities, now we are talking about enhancing qualities, qualities which enhance these primary qualities. So guys, we had two primary qualities here, relevance and faithful representation. Now we are looking at qualities which enhance these primary qualities. So the fence, as I told you, is cut by Varun. So C of the cut, that stands for comparability. The financials, they must be comparable. So if I pick up Ford financials, I must be able to compare it with General Motors financials. If I pick up 2012 financials, I must be able to compare it with 2011 financials. They must be consistent from year to year, comparable across competitors across the industry. So that's the C of the cut. That enhances these qualities. That's an enhancing qualitative characteristic. The U of the cut, that stands for understandability. This means that these financials, they must be understandable. They can't be written in Greek or Latin. Okay, I'm just kidding. I mean, they must be clear and concise. They must be understandable. T of cut, that stands for timeliness. These financials, they must be available on time. If you give me 2012 financials in the year 2015, I don't need it. I need 2012 financials within a few weeks after the end of the year. I can't wait for longer than that, because in that case it would not be timely. It might not be useful. It might not make sense for me to look at these financials. So timeliness is a qualitative characteristic which enhances these primary characteristics. So the fence, the enhancing qualitative characteristics, we have looked at. C is comparability, U is understandability, T is timeliness. Now the fourth enhancing quality is V, that's V for Varun, verifiability. Which means that there must be evidence around the preparation of these financials. We'll talk about this in auditing. So the auditor, he's going to come in and he is going to verify these financials. He's going to look at all the evidence, all the records that we have that created these financials. He is going to gather sufficient, appropriate, corroborative audit evidence. So all these qualities enhance the primary characteristics. So guys, we have looked at two primary qualities, relevance and faithful representation. They have their ingredients. You have enhancing qualitative characteristics. We said cut by Varun, comparability, understandability, timeliness and verifiability. Now, apart from this, we have certain constraints when we're doing these financials. So we have certain, we could say, constraints. And one of the key constraints that we have when we're doing these financials is we need to make sure, where we have certain costs in preparing financials, we need to make sure that these costs are less than the benefits that we are getting from these financials. So we get more benefits than we spend on these financials. Now, we might spend millions of dollars in getting these financials done, but are these financials providing us benefits more than those millions of dollars that we have spent in creating the financials? So benefits should be more than costs, or in other words, costs should be less than benefits. So guys, all these are qualitative characteristics of financial statements. So you have the constraint, cost should be less than benefit, you have primary qualities, and then as I told you, you've got enhancing qualities. The mnemonics that I've given you, make sure you remember it. Even on your exam, when you have a question regarding qualitative characteristics of financial statements, you can draw this mnemonic, you can draw this chart out on the scribble paper that you get, and make sure you remember every word of it. Review and pass CPA at miles. If you have a fence which is blocking you from CPA, I'm going to be there. The fence is going to be cut by Varun. On page 9, we're looking at the qualitative characteristics of financial statements. So you got a table there where we're looking at both GAAP and IFRS. First, let's look at US GAAP. So that's from the FASB Conceptual Framework, and underline entities not allowed to apply FASB Conceptual Framework to specific accounting issues. As I told you, these are like rules for the rule makers. Then you have qualitative characteristics. Put a box around qualitative characteristics and highlight primary qualitative characteristics. Highlight relevance. And as we know, there are two ingredients of relevance. So put a circle around 2 and highlight predictive value, highlight confirmatory value. Also highlight materiality is an entity specific concept of relevance which applies at entity level. Then the next primary qualitative characteristic, highlight faithful representation. And there are 3 ingredients of faithful representation. Put a circle around 3, highlight error free, neutrality, completeness. And now we are looking at highlight enhancing qualitative characteristics. Highlight comparability, understandability, timeliness, verifiability. And the last row there, put a box around constraints and highlight cost less than benefits, or benefits should be more than costs. Now, this was under the FASB conceptual framework for US GAAP. Now, let's go back up on this page, and now we're looking at IFRS. So that's the IASB framework. Now, as you can look at it on your book, you can understand that instead of having enhancing qualitative characteristics, IFRS has put it all together in the principal qualitative characteristics. So instead of having 2 primary characteristics, they've got 4. They've got relevance, they've got reliability, comparability, and understandability. Now, for timeliness, which was one of the enhancing qualitative characteristics under GAAP, they have put that as a constraint. So it's basically the same thing talked about in a different fashion. So let's write a little bit of notes on the bottom of this page. So write FASB and IASB, write primary characteristics. Under FASB write 2, under IASB write 4. Then you got enhancing characteristics, right? 4 for FASB and nil for IASB. Constraints for FASB write 1, that's basically benefits should be more than costs. For IASB write 2, that's timeliness and benefits more than costs. Now turn on to the next page, page 10. And here we are looking at the mnemonic that I gave you to remember the qualitative characteristics of financial statements. So highlight there constraint, that's benefits more than costs. Highlight primary. Highlight review and pass CPA at miles. And towards your goal of destination CPA, you got a fence blocking it. So highlight FENCE. So the E of fence, that stands for highlight enhancing. And as you guys all know, the fence highlight is cut CUT by Varun. So review and pass CPA at miles, there is a fence there and Varun is going to cut that fence. Now, whenever we prepare financials, we have certain assumptions behind the preparation of the financials. Few of them are economic entity assumption. It's assumed that the financials, they are being prepared for an entity which has an identifiable set of activities. For example, Walmart. Walmart has activities, retail. It gives you all that you need for your daily needs. It spent 50 years in helping you customers save money, live better. Economic entity assumption. The next assumption that we'll be looking at is going concern assumption. There we assume that the entity for which the financials are being prepared will continue to operate in the foreseeable future. You also have the monetary unit assumption. So all the numbers in the financials, they are measured by money, they are measured in dollars. So that's monetary unit assumption. Periodicity assumption. So you divide the life of an entity into meaningful periods. So let's say every year we have the annual financials. So this is a meaningful period of a year. So these are few assumptions behind the preparation of financial statements. Now on the financials, we also have certain principles. Few of them being historical cost principle. So a lot of numbers on these financials are based on historical cost. Now, to this principle, there are a lot of exceptions we'll look at when we're doing measurement basis. Full disclosure principle. So there's a lot of disclosures on these financials. So that's basically the full disclosure principle. You also have a principle which we call conservatism, because we are conservative accountants. We see all losses, all expenses. We don't see future gains. So guys, if it's a future gain coming in, we might not recognize it. But if it's a future loss, we'll take it today. Our focus is, so let's get there. Our focus is that we should not be overstating assets and understating liabilities. So we are happy keeping assets low and liabilities high, but not otherwise, because we are conservative. We do not want to show out a flowery picture. Think about it. If assets are more and liabilities are less, that's a flowery picture. We don't want that. We are conservative. We are happy with less assets, more liabilities. We are happy with more expenses, less revenues. So that's the principle of conservatism. Now let's look at revenue recognition. So before that, we're talking about recognition and measurement in this part of the chapter. A couple of principles relate to revenue recognition and expense matching. So we have a couple of principles relating to revenue recognition principle. So this principle says recognize revenue when it's earned and realized or realizable. So recognition is if it's earned and realized or realizable. So by recognition we mean get it onto the financials. So that's recognition when it comes to the financials. Earned means you've done all the hard work, you've really slogged for it. Realized, you've seen the cash. So guys, recognize it when it comes on the financials. Realized is when you receive the cash. Realizable is when you know you're going to receive the cash. So let's say we've sold goods on credit. So we've earned it, yes. We've done all the hard work in selling the goods. And let's say the customer to whom we've sold the goods, we never know he'll pay or not. We're not at all sure. So is it realized? Have we touched the cash? Not yet. Realizable? We don't know he's going to ever pay or not. In that case, this is not revenue. In another case, let's say from another customer, we've received an advance for the goods. Let's say we're doing pens, we're supplying pens. We've received an advance for supplying pens. Have we earned it? We haven't supplied the pens, not yet. Have we realized, or is it realizable? We've already realized it, we've received the cash. Do we recognize revenue on the financials yet? Not yet, because it needs to be earned as well as realized or realizable. But let's say we sold these pens on credit, on a 30-day credit terms, and we're pretty sure after 30 days we're going to get our cash back. So have we earned it? Did we sell the pens? Did we deliver the pens? Yes. Is it realized? Not yet. We have not touched the cash. 30-day credit. Realizable? Yes. Should we recognize revenue? Of course. So revenue recognition is when it's earned and realized or realizable. Next principle regarding expense matching. Now, for every period that we have our revenues, we're going to match expenses to the revenues. Two ways of doing it. We have product costs and period costs. So product cost, we're going to match expenses to the product. So like cost of goods sold. So the revenues that we have from the goods sold, sales, we're going to match COGS to sales. Period cost, like selling, general and administrative expenses. So we're going to match selling, general and administrative expenses to the period in question. So let's say this is the income statement for the year. So we're going to have SG&A for the year out here. Now guys, we're going to talk about this in detail when we get to the income statement part in the next section. So for now, understand revenue recognition, recognize revenue when it's earned and realized or realizable, match expenses to the revenue recognized. So guys, both these together, this is what we call accrual accounting. So we'll have more of this coming in towards the latter part of this chapter, but for now we have our principles pretty clear. Now, so we've looked at principle. Let's look at the recognition rules under GAAP. So now GAAP says recognize an element if. Guys, what's an element? We forgot. Let's go back. So these were our 10 elements: assets, liabilities, equity, investment from owners, comprehensive income, distribution to owners, revenues, gains, expenses, losses. So all these are elements. So when do you recognize an element? If the two conditions for that: number one, the element is measured or measurable in dollars. So element is in dollars. The next condition is the element is relevant and reliable. So guys, you're getting it the way this is linking back. So number one, the element should be measurable in dollars. Second condition for recognition is the element must be relevant and reliable. So we've just seen revenue recognition. So guys, these are all rules, concepts. We might not understand all of these because these rules, these are for those guys, for the rule makers, for FASB to make the rules. We don't apply all this directly, but still these are concepts helpful for us to know. So now we know the roots of how FASB, we know the secret sauces that FASB uses to give you all the US GAAP rules. So we looked at recognition. Let's look at measurement. Now we'll talk about measurement bases throughout the financial accounting and reporting section. So you could have a lot of bases. So you could have historical cost. Remember I told you about the historical cost, one of the historical cost principle. So that is basically you're having numbers at historical cost, amount that you originally paid. So for example, PP&E, property, plant and equipment, that's at original cost, historical cost. Another measurement base could be replacement cost. Now this could be used for inventory, which is valued at lower of cost or market. So we'll talk about replacement cost when we get to inventory. How about FMV? This is fair market value. So this is the fair market value of an item. So we could use it for investments, for shares, stocks that we own. Then you have NRV, net realizable value. This is fair value less cost to sell. So let's say if I have a equity security which is worth $300, that's the fair market value is 300. But if I sell that security, I'll incur $2 in selling the security. So the NRV, that's 298, $300 minus 2. So generally we use net realizable value for held for sale assets. So we'll talk about that when we're doing discontinued operations today. Another measurement base is also present value. So this is a discounted cash flow due to time value of money. So we could do that for bonds. We'll talk about present value in a little more detail when you're doing cash flow and present value in the next section, and we're also going to look at fair value. But when we get to bonds, leases, pensions, that's when we're going to do present value in a lot of detail. So guys, as you can understand, there's a lot of stuff here that's still to come in FAR, and I'm sure we're going to enjoy this ride. On page 11, we're looking at fundamental assumptions and principles. So we've talked about these fundamental assumptions: the economic entity assumption, the going concern assumption, monetary unit assumption, periodicity assumption. We've also talked about fundamental principles, the historical cost principle, revenue recognition principle, very important, highlight, recognize revenue when earned, that's your earning process is complete, and it's highlight realized or realizable. Either you've collected the cash or you have a claim to collect cash. Now turn on to page 12, highlight matching principle, and right there match expenses to revenues. On the next bullet, highlight accrual accounting is equal to revenue recognition principle plus expense recognition. So guys, the revenue recognition principle and the matching principle, these form the basis for accrual accounting. You also have the full disclosure principle and the very important conservatism principle. Now on page 13, we are looking at recognition and measurement. Highlight recognize a financial statement element when, highlight meets definition of an element. So on the left, right, FASB is equal to 10 elements. So sometime back we studied about all those 10 elements which was there in the FASB conceptual framework. So that's the definition of an element and it satisfies recognition criteria. So under GAAP, the recognition criteria is that element can be highlight measured in monetary terms, and the next one, element is highlight relevant and reliable. Then you have a lot of measurement bases on this page: historical cost, replacement cost, fair market value, net realizable value, present value. So you got the concepts here, and we're going to do a lot of practice on these bases as we move on with the course. Now, we're talking about statement of financial accounting concepts, rules for the rule makers, not included in AFC because it's non-authoritative. One of the concept statements talks about cash flow information and present value in accounting measurements. So let's look at that on the other side of the board, and we're working there. So this was elements, objectives, qualitative characteristics. Here we had recognition and measurement. And now we are looking at cash flow and present value. Cash flow and present value. Now, before I talk in detail, let's talk first about fair value. What is fair value? Now, fair value is a price that would be received to sell an asset or paid to transfer a liability in an orderly arm's length transaction between a willing buyer and a willing seller. So fair value is the price, let's say if you're selling an asset, the price to sell an asset in an orderly arm's length transaction. That means it's not to a related party, it's to an unrelated party, and it's not a forced sale. It's a willing buyer, willing seller transacting in an orderly fashion. Now, generally when you want to measure fair value, you're looking at what the market price is. You're looking at the market value. That's why it's also often called fair market value. So that's why you have FMV, right? Fair market value, because you're looking at the market price. However, if the market price cannot be determined, in that case, you might want to use something what we call present value. So if market price is not there, then you would use present value. Now, present value is basically you project future cash flows. So for the next year, X amount of cash flows, year 2 so much, year 3 so much. You're projecting cash flows for the future years, and then you use a discount rate to calculate the present value of all those future cash flows, and you get a present value number which is treated as a fair value if market is not available. Now, if you can't even do that, then you might use the cost approach. We'll talk about that when we are talking about fair value disclosures towards the end of this chapter. But guys, now it makes sense, right? So we're talking about this part here. We're talking about fair value as part of our concept statements. So we are saying we would use present value if market is not available. So present value would help us calculate the fair value. We're going to project future cash flows and then discount it, use a discount rate, discount it to current date, calculate what's the present value, value as of today. On page 14, we are looking at using cash flow information and present value in accounting measurements. So make a note there which says for fair value or FV, use market value. So generally it's preferred to use market value when we are doing fair value computations. only if market value is equal to question mark. So only if when we do not know the market value, right, use PV or the present value of future cash flows. So once again, we're making a note which says for fair value, use market value. Only if market value is unknown, use present value of future cash flows. Highlight, fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly arm's length transaction between market participants at the measurement date. Now come down towards the bottom of this page. Highlight present value computations. And there are two approaches that you could follow here. Highlight discount rate adjustment approach, which is the traditional approach for highlight non-variable or contractual cash flows. Next one, highlight expected cash flow approach and highlight subjective probability assigned to each cash flow in the range. Now let's wrap up all our understanding of these concepts by talking about the accounting cycle. Let me box it with a red pen. So in the accounting cycle, we are talking about financial accounting and reporting. So guys, that's the subject, far, financial accounting and reporting, not too far. So we start the accounting cycle by talking about journals. So journal entries, if you remember it from college, you know it's debit and credit. Don't tell me that's all you remember. I also assume that you remember your 3 golden rules of accounting. So you had personal accounts, real accounts, nominal accounts. Remember, in personal accounts, we debited the receiver, credited the giver. In real accounts, debit what comes in, credit what goes out. Nominal accounts, debit all expenses and losses, credit all income or revenues and gains. So guys, that was your 3 golden rules of accounting. For people who understand nothing out of this, let's go look at the elements of financial statements and then we're going to talk about what's debit, what's credit. So you have the balance sheet here, income statement here. Remember, assets, they are debit. Liabilities and equity, they are credit. On the income statement, remember, revenues and gains, they are credit. Remember, nominal accounts, credit, income or revenues and gains, debit, expenses and losses. So your expenses and losses, they are debit. Revenues and gains, credit. Assets, they are debit. Liabilities and equity, they are credit. So this would certainly help you remember the debits and credits. Frankly speaking, guys, this is all you know in accounting, and trust me, all you need to know. I'm trying to be the romantic John Keats for accounting here. Now, so we're talking about the accounting cycle. So we've talked about journals. Now, after journals, you post it into ledgers. Remember those T accounts? We'll do a lot of that in this course. Then you prepare the trial balance. So trial balance is a summary of all the general ledger accounts. And then you have the financial statements. So all this is accounting and then you report. So what are all your financial statements? Number 1, balance sheet. Number 2, income statement. So you know both of these. Number 3, statement of comprehensive income. Number 4, statement of stockholders' equity. Number 5, statement of cash flows. And then you also have notes to the financial statements. So guys, 5 basic financial statements and the notes to the financials. This is a complete set of financials that you need to report out. So guys, you're all set to be accountants to do all the financial accounting and reporting. Let's look at page 15. And on top of this page, I want you to write FAR. And that's the name of your subject, right? FAR is equal to financial accounting plus reporting. First, we are looking at financial accounting. Highlight journal entries and underline 3 golden rules of accounting. Let's look at the table there. So for personal accounts, you debit the receiver, credit the giver. Real accounts, debit what comes in, credit what goes out. Nominal accounts, you debit expenses and losses, credit revenues and gains. And then you post transaction journal entries to the highlight general ledger. And then we're looking at highlight trial balance. Now come down towards the bottom of this page and write financial reporting. So now you prepare the financial statements and footnotes. Highlight balance sheet, highlight statement of earnings, income statement, highlight statement of comprehensive income, highlight statement of stockholder equity, statement of cash flows, and the notes to the financial statements. On the right, highlight complete set of financial statements.